How you guys doing? My name is Logan Latin, senior underwriter and national property broker at GenCap Insurance Services. Um, just excited to be here with Akash.
Thank you, Logan. Julio.
Hey, good afternoon. My name is Julio Gonzalez. I'm with Kingdom Commercial. I'm an insurance agent. Look forward to getting to know you and working with you.
My intent, guys, is for this call was primarily I want to learn a little bit more about multifamily and how insurance works for multifamily. Because, hey, what we are dealing with as multifamily operators in the last 1 year, the insurance has gone up drastically for all of us. And it's one of those expenses, which is it's probably the highest or second highest line item on our P&L. One being your property taxes, second being the insurance, and third is the payroll. Those are the three biggest line items on any multifamily operators, P&L. And if we call it the uncontrollable expense, because we do not have any leverage on how to, we don't have any insight into it. We don't know how to control it. It is a black box for us on whatever our agent or our insurance company gives us. So I wanted to demystify a little bit of this, like you have been helping me play around with a little bit of limits, the deductibles, and how much to insure, and so on and so forth, right? So first of all, right, hey, what I want to do is get both of your take on the insurance itself, the multifamily, specifically as it relates to multifamily properties, and what your thoughts are on what we have seen in the industry in the last couple of years, if you may.
As far as what we've been seeing, really, it's just been kind of a hardening of the market, which for us means like rates are going up, carriers are pulling from the market. Also means carriers are getting a little tighter on terms. The terms are not as loose in a hard market. Generally, this comes from honestly things just that happen out in the world, or hurricanes, storms, wildfires, stuff like that. Really what impacted the insurance market in a big way recently was the cat storm out in Florida. I believe it was 2 years ago. Really caused 2023 to be a really tough year. And then going into 2024, you have some carriers loosening up, but you also have other carriers that kind of still haven't seen improvements just as far as the loss ratios and things like that. And so what they've been trying to do is they'll pull from classes. So, they may not write a certain risk type of risk class, or they just won't write in a certain area, be it like Texas, Florida, California, things like that. If we don't have a storm this year or too many wildfires, I can see carriers starting to pull back on rate and just kind of get a little looser with the rating and the terms and the deductibles and things like that. But I think what a lot of the actuarial guys and reinsurance guys are counting on this year is just for it not to be too heavy on catastrophic losses this year. And then they can kind of try to get back into the market and trying to really just be a little looser for the clients and customers.
To add to what Logan was saying, companies actually, and I'm speaking from Texas perspective also, they'll get more granular depending on what region of it's in, because there's more high risk. For example, the North Texas region, which encompasses Dallas, Fort Worth, those type of areas. A lot of them also depending on the season that's coming. So, for example, we're coming into the hailstorm season, right? It's going to be walking into. They'll close those markets for those regions, right? Because they consider them high risk. So it's hard to write those type of get that type of coverage within that season as well. So it depends on also what season that you're getting into, and if they consider it high risk, right? And also on the coastline, so the Houston, Galveston area, where there's a lot of to what Logan was saying, weather type of risk within there. So you have to look at that from that perspective as well as an investor Where are you investing in as well? What region? And again, just talking about the Texas portion of it, but it follows suit depending on where you are across the United States as well. Florida's been hit really hard as well because again, they get a lot of different weather storms that affects them as well, which again, either puts too much risk on a provider, either they'll close the market for a portion of it, or they just remove themselves out of that state completely sometimes.
But I also want to understand, hey, I think there are standard lines, there are surplus lines. So can you educate me and some of my viewers as to what different kind of insurance companies are there, and you as agents, who are you typically working with?
Yeah, usually on the wholesale side, the brokerage side, we try to stay with A minus carriers and above. The A plus, A plus plus ratings and all that. It's basically just the financial backing of the company. Just in simpler terms, you know, how likely is it them to go under or to, go insolvent is what we call it, where if there's more claims than there is money in the pool, and it can't be paid or has to be paid by a state guarantee fund, we call that going insolvent. So essentially that's what that rating is just saying, how strong is that company to be around and, just to be able to handle losses and things like that. When you're talking admitted standard market versus E&S and surplus markets, standard markets are ones that are backed by a guarantee fund with the state. Usually those markets have a small box of things that they like to do if you have a risk that's outside of that box in any real certain way. Usually they like to kick it to the surplus lines or E&S markets just because it doesn't fit what they want to write. Usually standard markets kind of writes your safer things. If we're talking, auto, they're gonna write, your Honda Civic or whatever. They're not gonna write, your exotic car, supercar, anything like that. If you're talking, properties like apartments, standard markets usually will write things that are new construction, brand new, usually 10 years old or newer. Sometimes they'll consider other stuff. They usually don't like to get too heavy on the limits. Once you start getting towards that 5 million and above, a lot of standard markets may shy away. Some of your more household names may still take a look, like your Chubbs, Travelers, and stuff like that. But even those guys don't like to play in the E&S space too much. Your E&S markets are going to be the ones that basically take a look at the hard to place risk, is what we call them. Your oil and gas, energy, older properties, properties that may have had a loss, things like that. That's where your E&S and surplus, carriers are going to be looking at.
What is the difference between E&S and surplus?
It's pretty much the same thing. Just a lot of people just call it a different name. Surplus lines, E&S, non-admitted. Those three things, when you hear that, it's basically your hard to place risk markets.
Got it. And then help me understand also the various layers within the insurance market. You have the insurance company itself, you have the consolidators, and then you have the agent, right? Like I guess, hey, Logan is I think Julio is my agent, but then are you the wholesaler? And then
Right.
you go, then behind you is a consolidator, and then there is an insurance company. Help me understand the various different layers.
Yeah, usually it's just the retail agent, the wholesale broker, and then the carrier. There's some markets that we call it going direct, where the retail agent can go direct. Usually a lot of the times that's your admitted market, or you're kind of like easier to place stuff. Usually when you start getting into some carrier risks like loss sensitive accounts and things like that, that's usually when, people get a broker involved, mainly because it's so much documentation, math, and just, accounting that goes into it, that usually one entity can't do it all. So you just kind of have to break it up and have people specialize. The agent is probably better for just handling the relationship side, handling a lot of the accounting with, the actual client, the wholesaler. Really their job, they have all the markets. So it's easy for them to consolidate information, put it through a bunch of markets, excuse me, and then, pick the best price instead of, a retail agent trying to handle a relationship with you guys and handle the relationships with the carriers. You kind of have to break it up just because there's so many different ways to place an account that usually you have to have a bunch of different eyes on it, especially when it's your larger kind of type stuff.
Got it. Got it. So, hey, when I go to Julio, just generally, do you typically only work with Logan, or you can work with multiple wholesalers? How does that work?
Yeah. So I mean, before I got to Logan, who is working with GenCap, I mean, in complete transparency, I reached out to 8 different other surplus providers, and these they're again are nationally, whether local, regionalized, or national type of surplus providers. A lot of them, in your example, Akash, was because of the age of your building. A lot of them would immediately just deter them and say we're not interested in that, because a lot of them, to Logan, saying they don't, if it's not new constructions, and a lot of them either categorize apartment buildings as far as, some will categorize new buildings anything that's 20 years or younger, 10 years or younger, and if it doesn't meet that type of strict standard, they'll immediately remove it. So I went through several different surplus providers. Thank God Logan and his company are, this is an appetite that they have within their infrastructure. And then they can also, like Logan was saying, reach out to multiple different producers that have a niche in those apartment type of verticals, or multifamily type of offerings. So
I've also seen a bunch of consolidators or a bunch of wholesalers getting out of the market. Like, hey, one of the reasons, Julio, that we started working together was because, hey, Goose Insurance, who had given me that previous quote, their consolidator or their wholesaler was USLI, and USLI got out of a bunch of markets. So help me understand, Logan, from your perspective, how many different companies do you typically work with or have deep relationships with?
At GenCap, I mean, we have relationships with hundreds of carriers. I mean, it even goes as far as to a GenCap office in Atlanta may even have a couple different markets than, say, a GenCap office in Texas or California. Mainly just because once you start switching regions, your exposure really changes when it comes to risk. So the guys in Cali, they're more earthquake focused. So a lot of their markets are more focused on an earthquake exposure rather than a wind or hail exposure. Like if you're sitting in Texas, your markets are probably going to be more geared towards hurricanes, tornadoes, hail, things like that. Florida, kind of same thing. New York is a lot of, their labor laws are just real strict. So you have carriers that are more focused on just the construction, the workers' comp, things like that. So I mean, yeah, I mean it's hundreds of different carriers, and then a lot of times, let's say if I don't have a contact or a carrier in Texas, and let's say it's a risk in Washington or something like that, if our carriers don't want to look at it, I can get on the phone, contact another GenCap broker in, let's say, California or something, and he probably will have a solution for the Washington account, and it's vice versa. Just play a lot off of each other, but yeah, I mean it's hundreds of carriers really that everybody kind of has different relationships with.
And we started the conversation with talking about how to control the uncontrollable expense of insurance, right?
Right.
Now, what is the best strategy for a sponsor consumer like myself who has many different multifamily properties? Hey, should I be looking at insurance and talking to Logan, talking to Julio every year and shopping it around? Okay, should I be having Julio go talk to 5 different wholesalers every year? Should I just be coming to Julio and say, hey, can you go talk to Logan And now, Logan, you go out to your 5, 6, 10, 7 different carriers that you like and get a recode every year. What is the best strategy for me as a consumer in your eyes?
That's a real good question. I would say usually we call it, so if an account was shopped. So usually if you shop an account, the brokers and the retailers are always trying to come up with the best mix of price and terms, sometimes just the best price in some cases. Once you once you find that carrier, if they don't change anything year over year, a lot of the times that account stays with that carrier. I know accounts that have been with certain carriers for like 25, 30 years, but it's just because they probably had a niche and a rating that was the most competitive out the whole market, especially when you get to the real big accounts, because there's usually only a couple players in it. The only time where, it's a smarter option to shop is if there was like a big change from that carrier, or let's say, they non-renew because they're trying to, you know, restructure their guidelines, or, you had a big rate increase. Usually that's when, all right, okay, well, let's see some other options. But usually if year over year, if you're seeing 5 to 7% increase or lower, or, the same premium, a lot of the times it's easier, or it makes more sense to stay with that market so you can hold the relationship with that market, especially if you have, let's say, you're trying to buy other properties. And then just so you can make sure, a lot of the times, if you're renewing with a certain carrier, you're basically grandfathered in to a certain like policy structure. I've seen people leave a carrier, and then when they come back, their policy structure is totally different than what they had before.
Got it. Julio, what is your perspective on this? Hey, we're starting this new relationship now with a few properties. How can you and your agency help me make sure I can control this uncontrollable expense?
Yeah, I think honestly, I think it is to the insurance agent on a yearly basis to see what's best for their client. In your instance, I mean, I would want to I obviously go to Logan and say, provide different packages, as far as sometimes not you had asked me prior to about a master policy of caution. Well, sometimes a master policy is good if you want to set your deductibles for all your properties at the same value, right? But now if you have different properties that you want to adjust the value, a master policy might not be the best fit for that. Where the more quantity that you have, or the more quality that you have, maybe a master policy might be a best fit for the overall premium across the board. Or sometimes going to individual properties and calling them individually and getting them on their own policies might be better for across all the premium. But that's part of my responsibility on a yearly basis to go to a Logan, and I would say not a yearly. I would say maybe every less than 2 years, look at the market. I mean, if the market has jumped, for example, last year the market jumped almost 30% on master policies, and so people that were tied to that master policy, regardless of whether they wanted to or not, had to adhere to that premium increase, right? Where and that agent might not have the flexibility to go shop those properties individually. But again, it's my responsibility to work with Logan, to work with multiple of these surplus providers to find you as the client the best outcome. But yeah, that statement, what Logan said, if the increase is anywhere from 5 to 7% on your yearly basis, well, it should match the increase in, I don't know, in hopefully in inflation and the cost of living, the labor, whatever it may be the case. As long as that matches that type of cost of living, then it's going in parallel. But if the premium outproduces what the cost of living is, then I think those are things that we have to look at. Those are metrics that we can use to help our clients out from that standpoint. So I say 2 years, but it's always actively. We're always looking. Hey, what is the premium going to increase? And that's something that I'll have to, in this relationship with Logan, I can reach out and say, hey, 90 days out, how are we looking on the premium? Can you give me an estimate of what's going to happen? What's your expectation of it? And so those are the feedback that we'll get from our communication and my relationship with Logan.
Logan, what is your perspective on master policies?
A lot of people like master policies. This is what I say. I tell people to get a master policy if you don't want to deal with the paperwork. But usually the issue with master policies is, so when you try to put so many locations and so much, we call it total insured value on one policy, unless you have a lot of syndicates. So sometimes, just to break down what a syndicate is, you'll have a basically an insurance company or an insurance paper where you'll have like 5 to 7 different companies sharing the risk of that insurance policy. So one person will take 25, 15, if you have, and usually it's tough to put those contracts together just because of logistic issues. Usually if you can have a policy like that, it's easier to make a master policy. But usually when you have maybe like a single carrier or 2 carriers to try to put maybe let's say 250 million worth of property values on one policy, it starts to make them want to take the rate up because they're taking so much exposure, especially if it's in a catastrophic area, let's say like Houston or something like that. Dallas is another one where it's like one hurricane or one windstorm can affect all the properties. It just kind of worries the insurance companies, because that's when you start talking about, smaller companies going insolvent or like smaller syndicates going insolvent. It's really just the pricing versus ease of logistics, really. I always think it's easier to, put a couple locations on a policy, but when you start doing like 25, $10 million locations, it just starts to get hairy, just because it's so much exposure, just compact on one policy. You have a cat loss, it's kind of like, it's just a lose-lose for everybody. So I usually say split them up between maybe like 50 to 100 million max. Anything over that, you want to look around, or especially if you buy them at certain times, I also think, find the right solution for that property. As long as your TIV is kind of under 50 to 100 million, you should kind of be fine on one policy.
Yeah. To add another thing that Logan just said, which I think it's key, another variable to look at. For example, if you're just purchasing, a property or refinancing a property, you could work. You can do all the pre planning as you can do, but then when you get the bank requirements, you have to adhere strictly to those bank requirements, and they're very strict on what requirements that they have for the policy coverages. So again, that can affect all the pre work that you've done, because now you have to adhere to that bank requirement if you're purchasing or refinancing a property. So that's a variable to look at.
That's a good segue into what we have been experiencing on our current recent buy as well, Julio. So talk to me a little bit about, both of you, talk to me a little bit about we always see 2 options being presented to us whenever we ask for insurance policies. One has terrorism coverage, the others typically don't, the 2 options. Talk to me a little bit about this whole terrorism coverage, and why is it needed? What is it? Why does Fannie and Freddie mandate it? Maybe some lenders do, and other lenders do also. Talk to me a little bit about TRIA or terrorism coverage.
Really, honestly, after it all came about really because of 9/11. When 9/11 happened, the insurance company and all the lawyers were basically fighting because the insurance company was saying that, you know, it was intentional damage. It's, usually intentional damage is not supposed to be covered. You know, the other side was saying, well, it's not something that was done by the client or, just done by the parties involved with the property. So there was just kind of a huge battle there. I think the claim was somewhere, I know it was over $1 billion, but yeah, it was like 1 billion and some change. And so after that, they just made, every policy you can either accept TRIA coverage or reject TRIA coverage. Usually it goes into a terrorism pool with the federal government. And, it's just helped to pay out in case of, a loss like that happens on, a client's property.
Now,
Yeah.
when we talk about terrorism, is it foreign governments or the foreign entities who are causing terrorism, or is it also domestic terrorism, where somebody just came out with somebody stupid came out with a gun and started shooting around? Is that also terrorism?
It's defined by whatever the federal government specifies it to be a terrorist act. It could be either a foreign or domestic, but it has to be vetted by the United States government for it to be an official terrorist act. If they don't identify it as such, then it's for naught. Now, who can enforce that? Again, unfortunately, we'll circle back to a bank loan. Bank has because they're you're borrowing money to pay that off. They can enforce that, and there's no ifs, ands, or but from an investor side. You have to adhere to that strict requirement to them.
But are you seeing that mostly from large banks or smaller banks, or are you seeing mostly TRIA coverage being required from Fannie and Freddie?
My experience is some of them what they call small business loans, which are loans anywhere below. Again, it depends on Freddie or Mac. Some of them identify small business loans less than $5 million. Another one identify small business loans less than $8 million. So when they identify that, they give the client the option to either choose it, but they don't require it. Anything that's beyond that, I've noticed that they require those type of terrorist coverages for that. So it just depends on what they consider small business loans or not, whoever. So it's Freddie, it's Fannie. I've seen them on those as requirements. But again, it's just based on what they deem as a small business loan or something beyond that. And they have thresholds within their own requirements.
Yeah. What about moving on to liability coverage? Right. Help me, kind of hash it out in the sense that hey, general liability typically on something like an apartments, we've seen $1 million, $2 million limits, and generally those are okay. But then we've also seen banks impose, or Freddie and Fannie impose extended coverage limits. Talk to me a little bit about liability coverage. Who does it cover? What circumstances does it cover? Why do we need excess liability? So on.
Usually the excess liability limits are because a certain party, either the bank or a lot of times we see it with construction where like a general contractor will require excess coverage. Mainly is to protect all the parties involved in case like a catastrophic loss happens, especially on the liability side. When you do insurance long enough, you really see some crazy stuff. And you'll see claims where you'll be like, how in the heck did that happen? And, it cost a construction company $5 million because a bridge collapsed or a building collapsed or something like that. And, you may have fatalities and things like that. So usually excess coverage is, you know, for those type of events where either, multiple people got hurt, multiple properties, you know, um, were damaged because of a certain event, like fatalities, things like that, where the courts are really, really going to be trying to indemnify the parties that were injured in a way that would, be substantial for something as, detrimental as like a loss of life or a fatality or something like that.
As an apartment owner, if I was negligent about something, then only will the liability fall on me. Is that not correct? If I didn't fix something, if there was a railing which was broken, which was not fixed, and somebody fell, hey, that is what that liability would generally cover, right?
Usually you don't necessarily have to be negligent for liability to kick in. It usually just has to be deemed that in the eyes of the court, it was, for a lack of better terms, your fault, or, the company that owns the building was at fault. Sometimes there's cases where there honestly is no real fault, but, you know, there was an owner of the property, something happened, and usually, how the American justice system is. Sometimes they just need somebody to come after. I would say a good example is like an apartment fire. Sometimes, hey, somebody was smoking a cigarette and, threw it somewhere where it shouldn't have been and caused a fire. Usually these days there's measures in place, where it's easy to, escape. But, like back in the early 1900s where, you have people trapped in the building or something like that, you know, may not have been the property owner's fault, but, you know, a lot of times the court system, when they are trying to indemnify those people, the first person they are going to try to come after is the insurance company. And, really that's why the insurance company is there, just so, families can get indemnified, get paid back on, injuries or loss of life and stuff like that, where it's not on the burden of the owner to try to take that financial responsibility.
Got it. What about so hey, we obviously will have we have liability coverage, and obviously if that can't be covered, that's why we have excess liability. I understand that, but hey, generally most of our properties we do have property management companies, right?
Mhm.
So is it also hey, do you see the lawsuits happening on the owners, or do you see it happening on the property management company, or it could be both?
In a lot of situations, it's both. So what we usually see, if it's a big claim, the law company is going after everyone involved. Management company, property owner. If the landowner is somebody different, a lot of times the landowner too. Same thing in construction. Usually if it's a big loss, they basically just try to hand out lawsuits to everyone involved. So usually that's why everyone has to carry some kind of limits, just because it's usually a lawsuit to everyone.
Got it. Now, a lot of our properties that we buy typically are syndications or pooled money, if you may. Hey, I'm a GP on a few properties, and then we have other investors who are limited partners in our syndications. Now, is it safe to say that, hey, GPs and LPs are typically not a party to something like this?
Um, what do you mean? Just as far as like if it's kind of
Like,
like private money investing almost?
that is correct. So, hey, we have private money investors in our deals. So, a lot of this liability would fall on the entity which owns the property. But then there are investors in this property, in that entity. It will not carry forward to those investors.
Um, that's a great question. I would say usually if the investors are properly hidden in the paperwork, then A lot of the times, if it's a commercial loss, they try to keep it on the commercial entity. However, there have been cases in the courts where, you know, they do try to come after the actual investors, but usually on something like what we're working on, where, it's, commercial stuff, apartments, stuff like that, they don't come after people personally unless that person was personally negligent or personally did something to, another person. Like, let's say a signing, seen it happen in a loss, an investor or whatever gets in an altercation with a signer or, a purchaser or somebody, and, get into a fight, and it's an assault and battery claim. It would take a special case. Let's say that it would kind of take a special case to where it wasn't on the entity, it was on the person.
Got it. Hey, because hey, I do get that ask that question, saying that, hey, I'm just an LP. What if the apartment got sued? Will I be impacted? So
Those are good questions. Those are valid questions.
Yeah, I say it's always best to be safe on the front end. If there's an exposure, if you're putting your money into something, on a commercial entity, it's best for every party involved to carry some kind of coverage, just so in the event that something does happen, they're not personally impacted, and it's, on the insurance company.
got it, guys. We literally have about 15 minutes here for this call. But another question also is, hey, again, going back to my controllable insurance expense. What Talk to me a little bit about how do your limits or the deductibles, help you, as a lever to increase or decrease the premium, and what are your typical limits that your typical deductibles that you recommend to your clients?
Usually, if you're looking in the eyes of the client, I would say a good deductible is usually a deductible that is worth it in the price. So, like, let's say you're at a 5,000 deductible, and usually I tell clients go to a $10,000 deductible if it saves you at least, a third or half of the premium of how much you're going up with that deductible. But generally speaking, you want your deductible to be something that, is, I guess, fiscally responsible. I know a lot of people who have kind of tried to go with an increased deductible where maybe they shouldn't have, and they're on the hook for that money, and then seen times where they just basically couldn't pay the deductible. A lot of carriers have been trying to pull back the higher deductibles, but usually I just say put it at somewhere where it's like, hey, I know for a fact if a $25,000 loss happened, it wouldn't be a problem to liquidate the money and pay for it. You want to be at a comfortable spot. Obviously price sensitive as well, but I always say, you just want to be in a comfortable spot where you can kind of maintain that deductible.
Julio, what is your take on the deductible?
Yeah, I mean, I have to, hook onto what Logan just said. I think depending, again, it goes back to where is your property at. If there's a high risk, for example, if it's in a high risk area, and you've had, if we can do some type of, I don't know, get some type of data on, again, the age of the building, the age of the equipment, what are the risks there? I mean, have we done our due diligence to find out, will it last? Will the equipment last another 10, 20, 30 years? Or will it be done in another 5 years? I mean, maybe you want to pay a higher premium because maybe you're exposing yourself to your equipment being damaged because of the age of it, right? And that might end up costing you a lot more than what the deductible you're paying. So again, it's so many different variables from that standpoint. Then you have to look at the weather as well. Is there freezing? Is there storms? Whatever may be the case. Again, you can take all these types of different variables, and I think each property it's its own. It's its own. How can I say? It's its own. I guess entity, right? So if you have sorry, I'm speaking around, but what I'm trying to say is this, Akash, is that each property it's its own entity. So you have to look at it as such. If it's a newer property, you might have a higher deductible there, as far as from the equipment standpoint, from the roofing, those high price ticket items, and so you might have a higher risk in saying, hey, well, I can have a higher deductible there because the equipment itself is brand new and the weather there seems to be good year round. So you might mitigate that type of risk. If it's an area where the weather's bad, the equipment is bad, maybe you lower your deductible, have a higher premium there, and cover yourself from that standpoint. But each property, you have to look at it differently in different ways because they're not all the same. You have properties that are built in the 1970s, and then you have properties that are built in the 1990s, and the conditions are completely different. So
with that, right? So what about the hail and wind deductible? We have seen it go on from 1% to 2% and as much as 4 and 5% right now. Talk to me, both of you. Talk to me a little bit about this increase that you've seen in the coverage for the wind and hail, and in what scenarios should we have higher versus lower limits on wind and hail? Based on your logic, right, Julio, if the roofs are old, then go with a lower deductible. And if the roofs are newer, then go with a higher deductible. Is that true?
Yeah, I would go off of that. Yes, definitely. Most definitely. You can't account for, again, the other thing too, you have to account for, cost, is that whatever provider you're going for, because again, depending on the location, they may not want to offer you anything lower than that. They may not, they might be a provider to say, no, I will give you a hell and win at 5%. You can take it or you can leave it. So then you have to start shopping around, right? So it's also another variable to add is, what is that provider going to offer you in that region, right? Hence, where we can go with Logan and, where he has access, or, service provider have access to multiple people across the United States. So again, those are variables that you have to look at as well. If you want a lower deductible, there's also deductibles as far as, now we'll start getting into what they call buybacks, right? You can reduce your deductible from a 5% to a 2% because there's these third-party companies that will offer that cushion between the 3% to lower it for you. Obviously, there's a cost associated to that as well. Sometimes it's conducive to get it. Sometimes it isn't, depending on your risk. So there's different variables depending on what you're looking for.
Oh, hey, this is fascinating. Hey, while we are at the topic of deductibles, one of the things that also fascinates me is the RCV versus ACV. Both of you, I question around RCV and ACV. How should you be looking at the policies? Why is ACV frowned upon?
That's actually a real good question because I'm one of those people who are a fan of actual cash value. A lot of people just don't like it because they want to be able to, I would say, if you want to be able to just say a property gets knocked down or a property has a loss, if you're looking for the insurance company to be able to assess the damage and then pick, usually the insurance company will pick a contractor or have you pick a contractor that's within their guidelines to fix the property. And, whatever the inflation is or whatever, the additional costs are to fix it in today's, market, you you'll get that money up to the limits. Usually I tell people to go ACV, usually for price reasons, just to kind of get a little better on the rate, get a little better on the premium. And then I tell people to go ACV if they're looking to get what they paid for it, essentially. A lot of times the replacement cost numbers are going to, more times than not, I've seen it'll be a lot higher than what a client paid for the actual property. And so usually I tell them, if you're just wanting to either get your money back or be able to recoup a payment, and then maybe, hey, you want to tear down that building and just go purchase something else. It really just depends on what someone's intentions are to do after a loss. If it's to rebuild, then I say go replacement. If it's to, recoup the dollar amount and, try to do something else with it, or, maybe just put it back into the property, then go ACV, or, if it's a price thing, go ACV. But yeah, if you're trying to just loss happens, rebuild.
And I think that's what the case is, Logan, in a lot of the buildings that we buy, right? We buy apartments. And apartments, if God forbid, if a loss happens, right? Our intent is, hey, we gotta fix it as soon as possible so that we can bring our tenants back in, and we can, put it back in a shape where the tenants will have a decent place to live, right?
Right.
And so that is what our intent is. Logan, any thought? Julio, Julio, any thought that you have on the AC versus RCV?
Yeah, I think from an ACV standpoint, I think if you're just looking to get your money back on it, if it's an investment to where you're just looking to to purchase, I don't know, some type of multifamily where it's a low risk type of environment, and I don't know, maybe it's an area that you don't see any progression as far as the local economy getting better. Maybe an ACV kind of coverage might be best fit. But if your investment in a region to where for a fact that in the next 5 years is going to multiply and the increase of value, and RCV is something. I mean, because you're investing into the future, right? You're investing into your net worth, the residuals that you're getting from your investor standpoint. So I mean, those are things to look at. Local region where you're at, is that marketplace going to be increase of value within the next 5 years? And RCV would be something that'd be best fit for that type of investment there. If it's a place that's very rural and there's not going to be much growth within the next 10, 15 years, then an ACV might be best fit for you from that standpoint. So just a footnote, because you were asking different, when are scenarios to do 5% hail and wind over another. I think if we just took like 3 different scenarios, and we can recommend, hey, we took this apartment building based on this information that we have, we recommend to do a 5% hail and wind on this. Again, it could be, as you're writing and as you're collecting the data, maybe we can build like 3 business cases on these are 3 solutions or 3 different scenarios of why each of these have different coverages, but it's based on, it's localization, building. So it's just food for thought as you move forward. Just my thought, because you were asking different ones. It just resonated. Well, if you're sharing and going to be writing, maybe we can build, and we'll definitely help you 3 different scenarios that have 3 different requirements, and why we came up with these 3 different suggestions for each of them.
Got it. And I think that could be an amazing matrix to work from, saying that, hey, if this is the kind of building and you're working with, this is the kind of area you're working with, hey, then these permutation combinations is what you should be shopping around for.
Yeah, exactly. Because then now we at least can expand on that, or at least give your investors some type of guidance on, hey, this is our gold standard, our silver standard, and our platinum standard, and this is why we, from an insurance coverage standpoint, why we recommend such coverage on it. Stuff like that. Just food for thought.
What about the property values themselves, right? A lot of the times, you have the purchase price of the property, then you have the bank loan on the property, that is at a different level. And the replacement cost could be much different than either one of those, right? How do you put a value to a property and buy the insurance for that property? Because the premiums could be very different for all three of those.
You can make your own assessment on a property based on the comps that you see, and that'll be your data point. But then you go to a bank, and they can give you, they can value it more based on their comps. And then you go to an insurance provider, and then based on the tools that they use, what they designate the cost should be to replace that can be completely different. So it's not like a streamline, that a thread that they can cross between all three entities. They're all, one graph bigger than the other. So you have to come to something. And Logan probably answer this more, but you have to come to something that's suitable for all three parties from that standpoint.
Hey, just for the property that we are recently buying, right? I came to you and said, "Hey, Julio, the price that you're giving for me, the insurance, is much higher than your competitor." And when we started comparing apples to apples, we saw that, hey, your RCV value was much higher than the insurance that I was getting at from the other carrier, right?
Mm-hmm.
So essentially, hey, your price quote was cheaper because based on the value that you had put to the building versus the other carrier. So again, I think very, very different pricing from an insurance perspective. And again, I think it's a matter of how much risk we are willing to take. But hey, how much risk is so what should those values be? Is there a happy medium between the purchase price and the loan amount, or the purchase price and the replacement cost value? How do you guys think about it? How does the underwriter think about it?
As an underwriter, I always tell people the purchase price of a building can be misleading, because sometimes you have instances where a property is getting sold or bought over or under market value. And then you also have a lot of times where the land is included in the purchase price, whereas an insurance company doesn't value the land. It's just the building that the land is on. Usually for us, the only time purchase price really comes into play is if it's like, okay, hey, he wants to go ACV. What was the purchase price of the building? So we can make sure, we get you a good ACV amount, at least for what you bought it for. But other than that, the carrier is going to want to know what the actual insurance to value is, which a lot of the times contemplates, if a loss happened, usually you have to remove items and then rebuild it to or, pretty much like new, or like how it was before. A lot of the times the insurance company, they want to use a contractor where they know what they're going to get. They know the contractor has insurance and they're comfortable with that contractor. That's why a lot of times there's a disagreement between client and insurance carrier, because a lot of times we'll have clients say, well, we can get it rebuilt for this. Well, a lot of times the contractor that the client's going to use is not going to be approved by the insurance company. And so, it'll be cheaper, but it won't be, the insurance company just won't feel comfortable doing it, at that price or with a certain contractor. So usually it's kind of geared towards the price of where they're seeing their contractors able to build it for.
Got it. Got it. What about the co-insurance? I think that is another bogey. There's another lever that we can play around with that increases or decreases the cost of insurance. So what do we mean by co-insurance? I know a lot of the people understand it in the healthcare terms, but in the property and casualty terms, co-insurance is fairly new, or at least people don't understand it.
Yeah, it's almost kind of the same as the health insurance. It's almost, I would say, almost like a copay. It's just kind of different because it just depends on what the loss amount is for properties. Because I know with medical payments, a lot of time, you'll have a copay, and that'll be the flat amount, usually with co-insurance. The carrier will give you 80% of the value or 90% or 100%. Usually depends on what your limit of insurance is compared to what the actual replacement cost is deemed to be at the time of the loss. So it usually just varies because the valuation at time of loss can be different than when you originally quoted it. And so that's why it's always important to just when properties do come up for renewal, kind of like Julio was saying, you just want to make sure you're within that 80 to 100% range, just so you're not taking a co-insurance penalty, or sometimes to make sure your property isn't just majorly overinsured.
Got it. Got it. Julio, do you have a perspective on the co-insurance?
No, I mean, Logan, I mean, yeah, I mean, he covered it correctly. I mean, you mentioned something about from a health insurance, and it functions the same way as far as from a property standpoint. I mean, it doesn't hold the client responsible with the co-insurance. For example, with you, what we're doing, we're eliminating the co-insurance aspect of it. You're eliminating that, which again, it's a benefit to you as an investor, right?
Mm-hmm.
Because if something were to happen, you don't have to come out of pocket for that percentage of replacement, whatever may be the case, right?
And I'm assuming co-insurance is over and above the deductible, like in the health insurance case.
Correct. Yes, sir. Logan, correct me if I'm wrong, but that's correct.
Yeah, the deductible is always first, so the co-insurance and all that doesn't kick into play until, after the loss has surpassed the deductible, and now you're talking about appraisal values and things like that.
Correct. Yes, sir. So yeah, that's pretty much it.
Guys, I know we are over, but I do have a couple more questions here. One is related to your equipment breakdown. In apartments, we sometimes have boilers and chillers. Most of the times, buildings don't have large equipment, except for maybe pool equipment or whatever else have you. But some older properties have boilers and chillers as some of the major equipment. Talk to me a little bit about how does that impact the insurance premiums on a property?
It depends on who the carrier is. Some carriers automatically include equipment breakdown for no charge. Some carriers charge for it. So usually it's kind of a case by case basis. A lot of the heavy property brokerage markets just already have it written in their policy forms to where they're not charging anything. They're just giving it to you just so they can be more competitive with the other larger property brokers.
Yeah, and the cost that's a data point that they also use. For example, I've asked you on different properties for the statement of value for, hey, what's the most recent HVAC update, electrical, roof, plumbing, and so they take that into consideration. If for example, in your standpoint, say your HVAC is more than 20 years old, well, then there's a risk for them as far as that type of equipment coverage. Right. So then that's going to obviously be used as a variable to increase the cost and lower the risk on the insurance provider. So it's critical from that standpoint. That's another point to really look at as you're purchasing maybe older properties or investing into it. You have to take into consideration, to your point, the equipment, the boilers, the chillers. These are 20, 25-year-old type of equipment. Again, you might be asked to fix that or bring it up to code in order for you to even get some type of coverage, right? So those are variables and things to consider as you're, looking into insurance coverages as well.
Got it. And then what about hey, one last question around the loss of business income. So that is, hey, we've seen that if something was to break down or if the fire was to happen, Then to put the apartments back in the same condition, it may take you 6 9 months. And during that time, you're not earning your rent either. So, what is there a rule of thumb as to what kind of uh, coverage should we have on rental income itself, and how does that impact the premiums? Because I saw that I think one of the buildings that we had, the rental income that we were covering was almost equal to the value of the property itself. So help me put some perspective in that.
So
Um,
go ahead, Logan.
um, rental income is usually tough, just because a lot of carriers, it's kind of a premium product. They're usually charging more for it than they are for the like building, just because it's when you have a loss, you start to get some clients drag their feet just because they're still getting paid by the company for the loss of value. I would just say usually when selecting a lot rental income value, you just kind of want to. Sometimes the bank just requires you to have an amount, but if they aren't, you just kind of want something that makes sense. I always say, and if it's a situation where you've had a prior loss there before, I would say it's just always good to take into account, what the rental income loss would be if there was a catastrophic loss. Usually you'll only have one of those a year. If you have any a year, but usually if one happens, it'll just be one. So really just enough to cover, you know, a catastrophic loss to multiple units, or enough to cover, where you may have had one unit had a small fire, and, you may need a month, 2 months to, put it back together. Um, just something that makes sense for really the investment itself, and just, to make sure you're getting paid adequately if a loss does happen.
Yeah. I would say a tool to use, Akash. You mentioned that you have HOA management uh, companies that managing the buildings. I think you can leverage their expertise, because they do the day to day, and pull information like when was the last fire, when was the last flooding that they have, and use that as metrics to use it. Because I mean, if the HOA has been managing an apartment building for 5 years and they've never had a fire or some type of plumbing issue, maybe you can use that as a metrics to help balance on what you actually want to, your business loss type of coverage, right? It's not always, it's not guaranteed, but you can maybe use that as a meantime to repair kind of data for you moving forward. Again, it's probably not what you want to hear, but again, those kind of things is really hard unless, like Logan has said, unless you have a bank loan, unless you fully outright own the building, then you have to adhere to the restrictions that a bank or is giving you on that as well. And they have those type of metrics. As far as what they use, I don't know, but I know they have some type of metrics where they come up with the business continuity type of coverage for
What
them.
about, hey, the way I think about it, right? Hey, our most of our complexes have multiple buildings, that they have. So like for example, one of our apartment complexes has 30 buildings. It's a 345 unit complex, 30 buildings, give or take about 10 to 15 apartments per building, right? What that really means is hey, if there was a catastrophic loss, I'm assuming it'll happen to maybe one or two buildings at the most. It won't happen to, again, yes, of course, if there's a tornado, it could impact 7, 8, 10 buildings.
Right.
But generally, if it was a fire or a water or something like that, it would happen to maybe one or two buildings in close vicinity to each other.
Mm-hmm.
Given that, hey, if suppose two buildings were down, about 30 units being down, and generally a fire remediation or a water remediation could happen in about 6 to 8 months time frame. Okay, if we were to look at 6 to 8 months times income from those 30 units, times, yeah, for the 6 to 8 months, that to me would be the coverage for the rental loss income. Is that a decent way to look at it?
I think that is a good way to look at it because usually losses make sense. You know what I mean? Just kind of like you said, for something to happen to 8, 10 buildings, like a tornado would have to roll through. Usually that's going to happen, once a year, if that, maybe once every 2 years. So I think, unless it's a hailstorm, usually hailstorms don't, put the tenant out of the unit. So it's usually just kind of, I think business income is one of those things where you really kind of have to think about what actually happened or what's more likely to happen. And it seems like you have a kind of a pretty good grasp on, okay, 2 buildings go down 15 units each. Okay, 30 units for 6 to 8 months. Like that'll probably be your most sizable loss unless, catastrophic F5 tornado comes through. And I think at that point, when you start thinking about, once in every 1 year or once or every 5 year events, I think, as a investor, you kind of start thinking about, okay, well, I'm not going to prepare for the end of the world because it doesn't make sense. Just as an investor, you kind of want to, at that point where you're thinking about something over 5 or 10 years, it's really better to save that money in your pocket and just have something laid away in case, something went over those limits. And then, of course, if something doesn't happen, you have that money. It's compound interest. You're accruing more money off of that money. So as an investor, you just want to make it make sense, really.
Gentlemen, this has been fantastic. Thank you so much. I really appreciate it. Anything that I might have missed?
I just when we first started, as you're presenting the different roles and functions of an insurance agent, an underwriter, the one thing I would share would be, think of your agent, your insurance agent, me, as your first point of contact or your liaison to the underwriters, right? To the to the Logans, to the underwriters. We're our your first point of escalation, not just from getting you a quote, but understanding what your needs are. And then from there, once we collect that data, we reach out, to our underwriters, our trusted underwriters, such as Logan, and work with him to provide our investors, their clients, the best solution possible for them. Again, understanding it's sensitive, price is very sensitive, but not sacrificing coverage as well. Come into a happy medium to where your investors, our clients, feel that they're being protected, that their investment is being protected the best possible way.
Got it. Logan, any last comments? Anything that I might have missed? Anything that me and investors like myself should look at when looking at insurance?
Yeah, I actually think the main thing is the price. Don't be deceived by a price on first instant. So like, how when they were sending over the USLI quotes, and I think they had, a location at like 500 grand when you may have needed like 2.5 million. Sometimes you'll have brokers that'll try to slash your limits and then show you a price and, try to get you to buy it. And just sometimes you just got to be careful because really the golden number a lot of times is what the rate is, because whatever the rate is, if someone's rate is better than another carrier's rate, and granted, you have to look at terms too, just because, hey, a rate may be higher, but the terms just may be so much better that it makes sense as an investor. But I think that'd be the main thing. Just don't be fooled on price initially. Make sure to do your due diligence. Julio did a great job, I think, just breaking down, what you were presented at first and just making sure, okay, I'll be the first one to tell, an agent or a client, if they have a good quote, hey, you have a good quote. I don't think we'll be able to compete. Go ahead and take it. But, you just want to be diligent in making sure you're getting the right thing for the right price, and you're not running into a situation where you got a good price, but when a loss happens, that agent or that broker is kind of leaving you hanging. So I think that'd just be one of the main things to just keep an eye on. And, that's a plus of having a good agent like Julio, good brokers like myself, and just making sure you have guys that are just staying on top of the stuff like that.
Guys, this has been awesome. I appreciate both of your time and effort here. Thank you so much.